Over 60% of Fortune 500 companies are legally headquartered in a state with fewer residents than the city of Austin, Texas. Delaware, a tiny state most of their executives have never set foot in. And the reason why is one of the most quietly powerful financial moves in America. This is not a loophole. This is not illegal. This is a system that was deliberately built. And the people at the top have been using it for decades while the rest of us were told to focus on budgeting apps and cutting out coffee. Here is what is actually happening. Delaware passed something called the Delaware General Corporation Law back in 1951. Over the decades, they refined it into the most business-friendly legal framework in the country. No sales tax on goods sold outside the state. No income tax for companies that are incorporated there but do not operate there. A specialized court system called the Court of Chancery that handles only business disputes and has no jury. Just judges who actually understand corporate law. That last part matters more than most people realize. When a startup in California raises venture capital, the investors almost always require it to reincorporate in Delaware first. Not because the founders want to. Because the investors know the legal protections are stronger, faster, and more predictable. The game is decided before the first product ships. Think about what that means for you. If you start a business today, registered in your home state, you are playing by rules that were designed for simplicity, not strategy. Delaware was designed for strategy. And the people who understand that difference are not smarter than you. They just learned the rules of a game you were never told existed. Let me give you a specific example. A 28-year-old named Marcus started a digital marketing agency in Ohio a few years ago. He registered it as an LLC in Ohio because that is where he lived. He paid Ohio state income tax on his business profits. He navigated Ohio's specific liability laws. Then his accountant, who worked with higher net worth clients, told him something that changed his financial trajectory. She said, "Marcus, you are not your business. Your business does not have to live where you live." Marcus formed a Delaware LLC. He kept operating from Ohio. He paid a registered agent in Delaware about $100 a year to maintain a legal address. His Ohio tax obligations on income he earned in Ohio stayed the same, to be clear. But his liability protections became significantly stronger. His business structure became more attractive to outside investors. And when he eventually wanted to sell the agency, the buyer's legal team had an easier time doing due diligence because Delaware's records and legal precedents are crystal clear. He did not move. He did not change his daily life. He changed the legal container his business lived in. If this is the first time you are hearing any of this, subscribe right now. Because this channel is specifically about the financial information that does not make it into mainstream media. We cover the actual mechanics of how wealth is built, not the surface-level version designed to keep you treading water. Now here is the layer underneath that most people miss. Delaware does not just protect your business. It protects your thinking. When you form a company in Delaware, you are forced to start seeing yourself as a business owner, not just a self-employed person. That mental shift is worth more than the tax benefits in the early stages. Self-employed people trade time for money. Business owners build structures that can operate, scale, and eventually sell without them. Delaware's LLC and corporation frameworks are built around the latter. The legal language, the operating agreements, the separation of ownership and management. It all pushes you toward thinking like someone who is building something, not just working for themselves under a different job title. There is also a privacy dimension that almost nobody talks about. Delaware does not require you to publicly list the names of LLC members or managers in most filings. In states like California, your name is attached to your business publicly. In Delaware, you can use a registered agent as the face of the filing. This matters when you are negotiating deals, because the other party cannot easily look up what else you own. Wealthy people are extremely intentional about information asymmetry. Knowing more than the other side is a structural advantage, and Delaware quietly helps you maintain it. Now, what can you actually do with this? If you do not yet have a business entity, start one. Even if your side income is small, the cost to form a Delaware LLC is around $90 in state filing fees. A registered agent service runs between $50 and $150 a year. You will need to check your specific home state's rules about registering as a foreign entity if you operate there, which adds a small fee. But for under $500 total in year one, You can have the same legal structure that billion-dollar companies use. If you already have an LLC or sole proprietorship registered in your home state, talk to a business attorney about whether converting or forming a parallel Delaware entity makes sense for your situation. The answer depends on your revenue, your state, and your plans. But you need to ask the question. Most people never even know to ask. The system is not rigged in the way most people think. It is not that the rules are secretly designed to hurt you. It is that the rules have layers. And the people who prosper are the ones who learned the deeper layers early. Delaware is one of those layers. And here is the thing that should genuinely frustrate you. This information is public. It has always been public. The Court of Chancery decisions are published. The state statutes are online. None of this is hidden. It is just never explained to people who did not grow up around wealth or go to certain schools or hire certain lawyers. That gap in access is what this channel exists to close. Stay for the next video because we are going into the specific operating agreement language that protects your personal assets when your business gets sued. That is the part even most new business owners get completely wrong. And getting it wrong can cost you everything you built.